Welcome to Keen on Retirement, a show dedicated to helping you thrive before and during your retirement years. If you are looking to grow and protect your wealth and want to make the second half of your life the best half, then listen in as wealth advisor Bill Keen sorts through the key issues that you need to know in a lively and candid way.
Hello, everybody, and welcome back to Keen on Retirement. I'm your co-host, Steve Sandusky, and as always, Bill Keen, Matt Wilson. Hey, guys.
Hey, Steve. How are you doing out in your neck of the woods?
Yeah, well, up and out, I think, from you, right?
Yes,
in
it
Kansas
is.
City, we are up and to the left. If you're
That's right.
looking at the map.
Yeah.
Yeah, doing great out here. Yep, and enjoying it. We're deep into fall right now, that's for sure. We're starting to turn into the rainy season here in the Pacific Northwest.
Okay.
No snow yet?
No, we don't. We don't get much snow here in Portland. We might get one or two little light dustings a year, but yeah, you just go a few miles away from here, and there's definitely snow up in the coastal mountains as well as the Cascades. So yeah, go skiing over at Mount Hood.
All right. Very nice, Steve. Did you get a lot of trick-or-treaters on Halloween there, or how does your neighborhood work?
Yeah, get a few.
Okay.
Yeah.
Okay.
We're steep hills here too, so they get a workout when they go from house to house. That's for sure.
Okay. Very nice. It's kind of funny, Matt. When Matt came over and started working with me or us together, he was from, I always say St. Louis, but he was from St. Charles, which is a little west of St. Louis.
Yep.
And not only did I convince him to come into Kansas City and stay after his internship in 2002, but I got him to move up to the north part of town, all in the same neighborhood. So we live in the same neighborhood up there, and our neighborhood gets a lot, doesn't it, Matt? It's fun.
Yeah. More your street more than mine.
Yeah. It does get pretty crowded, but we're ready for it. And of course, now with the grandkids, seeing the costumes on our grandkids, it makes my night. So good stuff.
For sure. Well, hey, got another good show lined up here. We've got a few questions that came in from some of your clients. You recently did a market update. So some of the questions that we have today are going to be market related. So always good to be talking about the markets here. But before we get to that, Bill and Matt, I know you guys recently hosted an event. So tell me a little bit about this event that you hosted.
For sure. And this was the second year in a row that we've hosted this event here at our space. And for those of you listeners and viewers that have been into our offices, we're really enjoying, we say our new space. It's now been over 3 years since we've been in our current headquarters, but we have a very, very nice, about 20,000 square foot facility here at one of the top floors of what's called the Lighton Tower here in Overland Park, Kansas, and really built it out to be able to be a fun and inviting place for our clients to come and visit, fun and inviting place for our team members to come to as well and enjoy the location, but then also sharing it with our community. And we do charitable events here. We do other on-site trainings. We have a lot of conference room space, and our main training room seats somewhere around 70 folks or so, very, very handily. And we had it's called the AEC PM Connect in last week. And that stands for Architecture, Engineering, and Construction Project Manager Connect meeting. And we've shared in the past that we work with clients from all industries, all sectors, but we really have a lot of influence, and we're grateful to work with a lot of folks from the architecture, engineer, and construction field. It's kind of evolved over time, and they make really, really good clients. You have to operate to their higher standards. I mean, they do have high standards, and some of them are very detail oriented. They're very planning driven, very process driven. But guess what? So are we. And we are able to operate to those standards. Those engineers, many of them have professional licensure, the PE license that they have to carry, and it's very hard to get, and they can relate to the certifications, the credentials that our advisors and planners have to get as well. So it makes for a really nice collaboration. And as a result of my book that came out initially in 2019, and then the second edition there after COVID, Keen on Retirement, engineering the second half of life, which applies to anyone, right? But especially speaks to that engineering mindset, I suppose. I was on a podcast for someone who's very influential. His name is Anthony Fasano, and he owns a company called the Engineering Management Institute. He does professional training and development for project managers and other engineering jobs across the country for some of the largest firms and some of the middle market firms, kind of all across the board. And we've created a collaboration over these years where Anthony has created a think tank group of PMs and other employees of engineering firms that gets together here at the Keen headquarters. We had people in from Montana and Ohio and the East Coast, Matt, and of course local engineers as well were on site. But it's really it's not a financial. It wasn't a financial program. I mean, I kicked off the event, spoke for 5 or 7 minutes up front. But other than that, it was just a day for engineers to collaborate, to share best practices. It was a spirit of, I really loved it. It was a spirit of abundance and collaboration, not of, scarcity and competition. It's people from, competing firms, yes, but people that just know that if they come together and share best practices, that they're able to serve their clients better and to have a better result, ultimately for their firms, which is exactly what, Matt, we do at the Barron's conferences and some of these other think tank groups that we go to as well. When you realize you can share, your best thinking with others and others are willing to do that, everybody wins in that format. So we kicked off the day, grateful to have the CEO of GFT on site. Mike Orth was here. I got to introduce Mike, had the pleasure of introducing him, gave a short talk on the importance of project managers in their fields. And we just had a wonderful group of speakers and panelists, and breakout sessions in all of our conference rooms were happening. And then I had the great opportunity to introduce a wonderful friend of our firm, Chris Baxter, who is a board member at Burns & McDonnell and 38-year employee there, team member there, and is the chief risk officer. And he just gave a fantastic talk to the group, about an hour and a half, on how they look at risk, or as he put it, uncertainty, how they manage around those things and think about those things up front before they get involved in projects and things that could have, all kinds of different avenues of risk or uncertainty. He actually liked that word uncertainty better than risk. And I'll tell you, I sat through his session. I was taking notes the whole time. I raised my hand, asked a couple of questions. He was really engaging the audience well. A lot of people were trying to kind of hide and not get called on because he's very dynamic and very, very intelligent. Started out as an engineer, just right out of college. And somewhere around 20 years into his career, he decided to get a law degree while he was working full time, building the Philadelphia International Airport. Just phenomenal individual, and now has made it to where he is today as the chief risk officer. A lot of responsibility in that role, but was just unbelievably grateful to have this caliber of folks and all the panelists and speakers and attendees on site here at Keen for an entire day, and then a nice reception after. And our team, the Keen team, was just amazing. I gave 10 minutes. They turned the whole place into a reception area as well, while people waited in the lobby for that to turn. So a lot of fun using our space for community and very productive event like that.
Well, I'm going to go off script here, Bill, because you just teed me up for something that I think is going to lead into the questions that we have here from the listeners. And you mentioned risk and uncertainty.
Sure.
So those are two terms that we talk a lot about and we think a lot about in financial services. So either one of you, tell me about the difference between risk and uncertainty, because we definitely think of those as two different terms when we're thinking about like building portfolios and financial plans. So tell me a little bit about risk versus uncertainty.
Well, I'm going to pull on, and I will let Matt speak. I promise. There's a lot of episodes where I just sit back and let you.
I'm going to cut you off, Bill. I'm going to hit the mute button for you.
Yeah, so like we're on a debate or something, right?
That's right. That's right.
Chris yesterday made a great point. He asked the audience. Now, remember, he's sitting there with a bunch of highly competent engineers that are designing and constructing some very large projects. And he asked the room to define the word risk. Define risk. And no one could define the word risk. He said, you've all just been trained. You say the word, but what does it mean? Define it. Somebody define it. And luckily nobody spoke up. And he said, well, that's great, because after thousands of people, that no one's been able to define risk as a word in and of itself. And that's why he said the word uncertainty is something we're all able to comprehend a little bit more. There's different levels of uncertainty. And he said, everything has uncertainty. We all have uncertainty. We all had uncertainty driving into work. If you chose to use an automobile today, just because you haven't had an accident for the last 10 years doesn't mean that today's not the day. Not to be morbid, but he was just saying every single thing, every decision we make has some semblance of uncertainty or risk around it. So with that in mind, I was thinking, how do we assess these things he's talking about on a project? He said, well, hey, we could eliminate all the risk contractually with a project that we're doing. But what happens if we were completely protected contractually? The best contracts in the world with a client, and something goes wrong with the project that was not had anything to do with the engineering or construction, and they can't pay their bill, they go bankrupt. Well, there's a whole nother risk that you thought you had no risk based on contracts, and all of a sudden there's this other risk that is a very real risk, and it's happened to them and others, right? It's happened to probably every single engineering firm that exists where a client, are they able to pay, the bill? So when you think about that in the context of us, Matt, I was thinking about, we talk about risk, and we don't like that word risk. When people say the word aggressive, we want an aggressive portfolio, or we want a risky portfolio. What risk are you talking about? Are you talking about longevity risk? You live too long and run out of money? Are you talking about that inflationary risk? Are you talking about reinvestment risk? Most people are talking about volatility of their accounts when they talk about, quote, risk. But the risk is someone makes a behavioral mistake and mistakes a temporary decline for a permanent loss and sells everything. That in and of itself is a behavioral risk that you also have to address. So, Matt, I mean, I don't know if you want to add something to that.
How I think about it, in the context of investing, is risk can be those, you have those different aspects that Bill just mentioned, but you also have the risk of permanent losses through overconcentration in individual positions or concentration in one industry. You could be diversified in an industry, but that industry may not perform well. I mean, we've seen that happen before where, great example is energy. When oil prices were high, energy stocks do well. Well, if that changes, and changes fundamentally, that oil companies aren't going to be as profitable in the future, you're diversified, but you're in the wrong area. So that's, that risk of permanent loss or not being able to recover. The uncertainty side of it, I look at that as more, is how certain are we, or how can we minimize the uncertainness of you getting to your destination? So via diversified portfolios, but even how much in equities versus how much in fixed income, because you have inflation that'll eat into the portfolio, and if you're too conservative, now that might create certainty
short term,
but it's now increase the inflation or purchasing power risk. So, that's very similar to how Chris was speaking about on you can have eliminated or have certainty in certain areas, but then you've just increased the risk somewhere else.
That's right. And, as he was speaking about some of the statistical modeling they do, I hesitate to even use the word Monte Carlo analysis, because isn't Monte Carlo a gambling city, I guess. But he was speaking, he gave a lot of examples about probabilities. But probabilities are extremely useful. And with the computing power we have today, we can, in fact, as you mentioned just now, we want short-term security. So we put all our money into a money market fund or a CD, but that produces a lot of long-term uncertainty. Or we could almost say that it creates it's certain that someone will run out of money if they do that. Longer term, if they live long enough and inflation continues on the rates that it has. So with the modeling, and I bring 34 years of experience in seeing how these models have actually played out in real life through things like 01, 02, and 08, 09 when markets were really poor. Matt, you're coming up on 25 years in the industry as well, so you've seen this as well. But with these models, we can create the intersection of all of what we perceive as risks or uncertainty and come up with probabilities of success. And remember, you're never done with that process in the financial planning process. Every decision someone makes on how much should we spend, how much should we donate to charity, how much should we gift to our children, what should our goals be, how much should we use to travel, to build that second home. All of those things, if they're measured and bounced or allocated as a part of the overall plan, we can assess the give and take of these things and come up with some really solid probabilities. So we're not eliminating all uncertainty, but we're doing a pretty darn good job of getting some high probabilities on things that we believe will work long-term in the context of what's important to someone. Because somebody might want to leave a huge estate to their kids and someone else might not want to. They might not care about that. So that changes the inputs to the model. This is why we always say the financial plan is so much more important, or it's the first place to start. I mean, the engine to the plan, the investments, which we are going to talk about today because we had a lot of questions on Matt's webinar. He does fantastic work. Everybody that comes in that I see in the lobby and greet and say hello to, they're like, oh, we just watched Matt's webinar and it's wonderful. And sometimes I'll go get him and bring him out and say, here he is right here. You can see him and talk to him in person. Of course, we get to do that today as well. That engine to the plan is important. It's got to perform. But the plan itself is where it all starts.
And Bill, you used the word probability. I think that's really the key distinction here as we're talking about risk versus uncertainty. So
yes,
risk is we can model the probability of that thing happening. For example, you take a die, I guess is the singular, and there's, six numbers on it. Well, we know if we flip that thing, we know what the probability of landing on any one of those numbers is. So there's enough data historically to be able to model the probabilities of something happening. So that's the risk. Risk is simply, we know the probabilistic outcome of something happening with some reasonable certainty because there's enough data. Whereas with uncertainty, these are basically unknown unknowns. Like we don't know what the probability of something happening. We don't know the probability of somebody dropping a nuclear bomb out of the blue, or the probability of a pandemic happening, or the probability of an earthquake. It's like there's not enough data to come up with a reasonable probability of something happening. And so both of those exist in the financial markets.
They do.
A lot of it is risk in the sense that we've got decades and decades and decades of data on market returns. And so we have a pretty good idea of what to expect in terms of returns going forward based on many decades of data. So yes, there's risk, but we have a pretty good understanding of what the parameters and the contours of that risk looks like. Whereas uncertainty, things like COVID, for example, people say, hey, we're going to have a pandemic, but we have no idea whether it's going to happen today or 20 years from now. So there's uncertainty there. And your point, we talk so much about the financial plan in these podcasts. And I think that is so important because it's the plan that helps you really be resilient for the uncertainty. The plan also takes into consideration the known risks out there. And so the combination of the two make clients resilient because we're understanding what the known unknowns are. That's the risk. The unknown unknowns is the uncertainty. And the planning process helps make sure that you're going to be covered during both of those.
That's right.
That's right. I love it. That's a great way to kind of summarize that, Steve. And we do we do the very best with all of the information that we have to be prepared for whatever tomorrow might bring. As opposed to just going dormant and crossing your fingers and hoping it all works out. You've got to do the best with the information you have, be truthful about your resources, I say all progress starts with the truth about where someone stands, assets, liabilities, dangers, opportunities, strengths, weaknesses. And then you make a plan from there with the best information you have, and you keep it updated over time. And then when you let life happen, and we're ready for it.
Yep. And hope is not a strategy.
That's right.
Fond is saying that. Fond is saying that as well. So
that's right.
All right. Well, let's jump into some of the questions here. The first one we've got here is from David, and he's asking, will the government shutdown reduce the overall inflation rate? What do you think, Matt?
Yeah. Speaking of risk and uncertainty, I mean, yes, we know this can happen, but is it going to happen? And when is it going to happen and how long? And, we're in this situation where, the government has shut down. We touched on it kind of briefly on our last podcast, but the short answer is not in a meaningful way. And one, because when the government isn't spending, or at least not spending as much as it had been, because discretionary spending gets turned off during these government shutdowns. Yes, it can slow down those areas or those sectors or the industries that are more reliant upon government contracts. But when you look at the makeup of inflation and where people spend their money, that's not necessarily going to have a meaningful impact or change to that. And I think the other aspect to this is that because we know it's always a win, the government is going to get back, they're going to come to an agreement and they will get back on spending again, I guess we'll put it that way. Whatever didn't happen during the period of the government shutdown will then start happening again.
Mm-hmm.
So it doesn't just say, oh, well, those 30 days, 60 days, however long it is, well, that's just whatever projects were supposed to start, we'll never start them. That's it. We lost the opportunity. No, it'll all just get crammed into whenever that period starts back up. So you could almost make the case that it could, short term, slow it down slightly and then bump it right back up. So it's a net neutral ultimately when it all kind of washes out.
Kind of interesting, like a bigger scale example of that. When talk about shutting something down temporarily, you know where I'm going with this? I'm going
your credit card whenever the fraudsters shut it down.
Oh gosh, I wasn't even going there. Yeah.
Oh man.
Yeah, no, that happens every so often, and so that's a thing we all deal with. I was thinking of COVID, where everything shut down, right? Everything, and so all these. Now that did affect short term; it affected all the data.
Yeah, well, and it also just changed where people spent money.
It surely did, and then things came back, and though now we've somewhat normalized. Of course, that was a little longer cycle than hopefully this is. The government shutdown isn't as long as the cycle it took to go through the COVID shutdown, if you will, and then getting things back normalized.
Yeah, because I mean, the long-term drivers of inflation, you think about the different inputs to it. It's like, well, food and energy. Well, the government shutdown isn't necessarily going to impact that. Global supply chains. Well, yeah, tariffs and things like that can have an impact, but it's not shutting those down. It's not reducing labor costs. Wages is a big component of inflation, and then consumption. Now those workers that are furloughed may not be spending as much. If you're an employee of the government and if you don't have a paycheck coming in, that's going to be an issue. But the workforce that's in the public sector versus the private sector is not significant enough to have a meaningful impact on the macro inflation data.
Excellent. I always wonder when someone asks a question, is there a secondary question to it? He asks, will it cause inflation to go down? And if so, then what? Was there any secondary question behind that? Like, then what? Does that make the Fed want to reduce rates more, or does that make stocks go higher, or whatever? Maybe there was, but I'm only imagining.
Yeah.
Well, speaking of stocks go higher, I think that leads us right into the second question here. This comes from James. So as we're having our conversation today, stocks are at an all-time high here in the United States. And so James is asking, are equities, in this case stocks, are they overpriced? And it appears that only a few stocks are currently driving market returns. How are the rest performing? So what do you think here, Matt? What's the data showing us here?
Yeah, I mean, I touched on this. I talk about valuations a lot during the webinars because our equities or stocks overpriced? That's another way of saying, well, are they fairly valued? Are stocks fairly valued? Are they undervalued? Are they overvalued? Meaning, are people paying too much for, to own that share of stock relative to the earnings that that company or the basket of companies that make up the market uh, are earning? And that's a big component because stock prices are a function of earnings. And there's other kind of forces that will change the way people think about, well, how certain am I of the ability for that company to make those earnings, or how uncertain am I? And that can impact the valuation. What are interest rates? So what are the alternatives to owning stocks? Well, if interest rates are high enough and you can get a guaranteed rate of return by owning a government bond or by putting your money into a CD, if that's high enough, well, then that might lead to stock valuations coming down because the alternative is is more attractive. It's more certain, and that incremental return that you're expecting in stocks isn't worth the extra risk relative to those fixed rates. Um, where I think we're at is when you look at valuations, it's almost always in the context of, well, where have they been historically? Because, well, any point in time, yes, this is where stocks are today, but relative to where they've been in the past, are earnings, are stocks earning more? Are they earning less? And as the price is high and earnings are down, that's where you lead to higher valuations. And we've gone through periods where valuations have been higher. Late 90s is a great example of that, where stock prices just continued to increase for a few years, even once kind of people and even the Federal Reserve at the time. Alan Greenspan was the chairman of the Federal Reserve, and he called it irrational exuberance. And he said that in 1996, and the market didn't peak until I think it was March of 2000. So even at that point, it took 4 years for it really to make a difference. And it's because there isn't just this, hey, a buzzer goes off, and once valuations hit this mark, stocks go down, or people just quit buying them. And valuations, I look at it too. It's very hard to compare them on a historical basis, and it's because there's different things that are happening today that didn't happen in the past. And one of them, I believe one of the important things is that there's more access to information. So people are willing to pay more for a stock because they feel like they have more certainty about the future. Whereas 50 years ago, valuations just were lower, and you didn't have the access to information. I know we talk about this a lot. Like, you got your stock prices by reading the newspaper or watching the evening news. You didn't get alerts second by second on your phone, or able to refresh your portfolio in real time and see exactly what's going on. I mean, now, anytime anything happens, it instantaneously, my phone's always buzzing. And, it's just always, well, this company's doing this, or the president said this, or they announced a trade deal, or the tariffs are increased. I mean, you get because they all want to be the first to it, whoever those reporters are. So you get this instantaneous access to information, and the market reacts so quickly to that. And that's why I believe valuations are most likely going to be higher in the years going forward, because it's just a different dynamic than we've had in the past. Now, the second part of his question was related to, well, what stocks are driving the returns of the market. Because, when we talk about stocks or the market, a lot of times it's reference to the major indices, the S&P 500, the Dow Jones, the NASDAQ, and those are baskets of stocks, and they have different ways that they're put together. But it's very common. The S&P is to be quoted, and it's market cap weighted. So what that means is that the bigger a company is, based on its market capitalization, which is a formula, it's the stock price times the number of shares outstanding. That's all it is. The bigger market capitalization it has, the bigger weighting it has within the S&P 500. So the biggest stocks have the bigger impact. Now, so even as we're going through this past year and the past several years, we've had companies that have eclipsed the $1 trillion market capitalization, and several of them are multi-trillion-dollar companies. And if they're included in the S&P 500, which most of those big mega caps, as we call them, are, they're having an outsized impact on the S&P 500. But that doesn't mean that the other companies aren't doing anything. And it doesn't mean that the other asset classes that people might own, because the market isn't just the S&P 500. There's thousands of stocks out there, and there's many asset classes, and they do different things at different times. But just because you're only hearing about the one doesn't mean the rest aren't doing well. So couple of different ways we can kind of look at the different asset classes, but we have U.S. based companies and U.S. based stocks, stocks that are headquartered here, and the highly quoted indices or benchmarks for that, the S&P, the Dow, the NASDAQ. But you also have benchmarks or indices that track the mid-sized companies and the small companies. And as of about mid October or so, S&P was up 16, 17%. The NASDAQ was up about 20%, 21%. The mid-cap companies, small-cap companies, they were up 5 and 6%. So while, yes, they haven't performed as well, but that doesn't mean, you shouldn't own those, because there'll be periods where those perform better. But then you have companies that are headquartered overseas. And we look at that at different, there's developed countries, there's emerging, countries, and those stocks have actually done even better than the U.S. based companies. And this is for 2025 year to date. There's a benchmark that tracks, it's called the All World X US. So it's everything except for U.S. headquartered companies. It's up 28% this year. So the rest of the world is doing better, from a stock performance standpoint than the S&P 500. And so, well, why is that? Well, some of it's related to the tariffs, because there was capital that flows globally between markets based on what's going on. And if there's, some fear that maybe, the tariffs could really slow down the U.S. economy, maybe there's some better opportunities on an international basis. But also the other impact to that is the foreign exchange rates between all those different companies.
Sure.
Because if you're buying in dollars and having to convert it to another currency, and then that exchange rate changes throughout the year, that can increase or decrease your returns, even though the companies themselves didn't, their performance was separate from that. So a lot of different factors that go into it. But I think it's important, though, not to just look at what's on the financial media and actually understand what really is the stock market and all the different ways you can invest in it.
For sure. It looks like Alan Greenspan on December 5th, 1996, first used the term irrational exuberance.
Yeah.
And just for interest's sake, I looked at where the Dow Jones was on in December of 1996.
5,000.
Any guesses, Steve? Guess?
5,000.
Over, under, Price is Right? Matt has
No,
5,000.
he does. That's not fair.
Oh, I'm going to say over.
All right. Well, I mean, no one gets bonus points for the answer here. It was about 6,400, something like that,
Okay.
around 6,000, little over 6,000. So when Alan Greenspan made that big, coined that phrase,
yeah.
the Dow was at call it 6,500, even somewhere around that. Today we sit at somewhere close to 48,000.
Yeah.
So while even if folks think things are temporarily overvalued, please don't forget the overwhelming power of the capital markets long term. If we understand this wisdom around it and we can harness the cycles instead of being whipsawed by the cycles, it can make nearly anyone, if they start early enough, be able to be financially independent in their lives if they understand
Well, just think about it, because it's like, okay, let's say you were paying very close attention to what Alan Greenspan said then, and it made you nervous and you sold everything.
Yep.
When would you have gotten back in? That's the next thing. You have to then make a choice to get back invested. And it's much easier, yes, with hindsight, to say, well, I would have bought back in the lows after the dot-com bubble. And I can tell you, every single person that I've talked to that has sold has never gotten back in.
Right.
Or at least not to the extent that they were invested before.
Right.
And it's because when things are down, now all the headlines are, well, when it's just going to get worse. And
of course,
all the economic data, a lot of it is lagging too. So you're getting reports on what's happened in the past, and markets and market participants start thinking to the future at a certain point.
Yes.
Not about the data. One of the data points that can take a while to come back is like the unemployment rate. You might see it continue to go down, even though the market's up 20% or 30%. And then what you're thinking, and the folks that have sold, this is what the thought process is. It's like, well, it's just going to come back down. I'm not going to get invested now. Or I missed it. I missed it.
Yep.
I didn't get in at the exact, because you're looking at these point to points, and it's like, it's still cheaper than what it was. You just need to get back in. Like it's really hard behaviorally for people to make those decisions. That's why you got to have a plan.
Right. Which is a risk that I shared right at the outset when we first started to open the program. That risk that you just talked about, that behavioral risk, a good financial advisor, fiduciary planner will help people avoid the behavioral risks. Someone in the exact same investments can have a very different return experience and overall experience based on their behavior, not the underlying investment, but their behavior around it. That's risk. That is a risk that you have to manage.
Yeah. I mean, it's just so interesting because we meet and talk to a lot of people, and there was someone I was speaking to, and they were telling me, they figured they had this great trading investment strategy, and they are investing in some very, very, hot stocks that have been performing really well. They're in the news, and what they were showing me was that they had basically employed a stop loss type strategy. So as the prices went up, sure, they own those shares, but then if the prices dropped a certain percentage, then it would trigger a sell order and it would sell out. And their account, it doubled over some period of time, and they were just super excited. And I started thinking about it. And I they told me their starting point and the starting capital and like the number of shares and everything. And I didn't tell this person this, but I just did the analysis myself. Had they just owned the shares, it would have been up 300%.
And not been in and out and all that, right?
Yeah.
Right.
Exactly. And by doing all that, not only did they miss out on returns, they triggered short-term capital gains on those trades that they had to pay taxes on.
Right.
The person who just bought and never thought about it again, at least with that stock, they haven't paid anything in taxes.
Right.
And they have more money.
Right.
And they're probably a lot less stressed too.
Which is, what's the price tag on that, right?
Exactly.
Yeah. One of the things that James had also asked here is it just a few stocks that are really driving the performance? So I think many of us have heard of the Mag 7 or the Magnificent 7. So these are well-known companies like Microsoft, Amazon, NVIDIA. And I think one way to look at that, and this is some of the data that you had shared earlier, Matt, is the S&P 500, as you mentioned, is a market capitalization weighted index, meaning the bigger the company is, the more weight it has in calculating the overall performance of that index.
Mhm.
Well, there's also something, as you guys know, called the S&P 500 equal
Yep.
weight. And what that simply does is it says, hey, I don't care if you're Microsoft or if you're the 500th biggest stock in the S&P 500,
Mhm.
your performance is going to be weighted exactly the same when we calculate it. So basically, I think it's 0.2%.
Yep.
Each company is weighted 0.2% to calculate the return. There is a difference this year in the market capitalization weighted, and the data we're looking at here as a base here, like in mid to late October, the S&P 500 market cap weighted was up 15.6%, and the S&P 500 equal weight was up 10.3. So a pretty significant 5 percentage point difference. So yeah, that would definitely indicate that the larger companies are having an outsized impact in the performance of the index this year. So just, and that happens, right? I mean, we've seen that happen a lot.
What also happens is not, again, not saying this is going to happen, but in the last 6 or 8 weeks of the year, the equal weight one could catch up.
It could.
I mean, returns come in spurts and no one knows when that's going to happen. And then
That's
all
right.
of a sudden you look at the end of the year and the S&P was up, whatever it was up, and the equal weight was up, whatever it was up. Because we put these calendars on the market. The market doesn't care about that. I mean, it doesn't know what month it is, or us as participants know, but it doesn't mean that, oh, well, I need to sell that one and go buy this one because it's up more this year.
Which would almost be the opposite, honestly, of what a
Mhm.
truly professionally managed and properly rebalanced portfolio would
That's
do to
right.
harness the cycles, because it all works till it doesn't. One asset class runs and it stays ahead until it doesn't. And that's, I think, another human bias that so many folks have. It's called recency bias. It's what's happened recently we think is going to happen forever. And people, there's a lot of you feel really smart when everything's going up. All I know is that if I have a family, they've built up a life savings, they are now done working, or they're on that track to being able to quit working. I want to create a portfolio that's professionally managed that will get them to their destination under all circumstances, and not try to get sucked into whatever the highest flying thing is at the moment. And that's been different things over my career in 34 years.
Oh, yeah.
I want to create a portfolio like people that manage wealth, manage money to get people through whatever it might be that comes at them, and not allow ourselves and our clients to get sucked into whatever the thing that's working the best might happen to be at the moment.
Well, we've got 2 other questions here, and I think I'm actually going to combine them because I think they tie into what we've been talking about already. So one is from Diana, and she says, I keep hearing from interviews on the news, et cetera, that the, quote, bubble will burst soon. Should I move some of my money out of stocks? And then the other question from Doreen is, what is your strategy for taking advantage of volatility in markets? So you've touched a little bit on, do you take money out of stocks? Essentially, do you time the market, when to get in, when to get out? I think you've touched on that a little bit. But then also, do you have a strategy for taking advantage of this volatility in the markets?
Yeah, I want to touch on this bubble question too. And something that you said earlier, Steve, the Mag 7 or Magnificent 7, which was, referenced as James' question, those stocks. Well, what happened to FANG? Remember FANG?
Yeah, that was an
Or
acronym.
FANG-M, and then it's because it changes.
Or the Nifty 50. Remember that from back in the years ago, many decades ago.
Oh, yeah.
It wasn't the Mag 7, and no one's been saying Mag 7 for 25 years. And it's not the same set, it's just these things change, and all of a sudden this acronym shows up and it acts like that, well, you should have known that, or everyone should have known what those were.
Well, let's test you. FANG, okay. What are the 4 stocks in FANG?
Facebook, Amazon, Netflix, and Google. And actually there was 2 A's. The other one was Alphabet.
Alphabet.
Oh, that's
yeah.
so 2 A's, man.
Remember that,
You
Steve?
didn't stump him, Steve. Netflix. That's interesting.
Fang.
That's interesting.
Not just
Yep.
Fang, but
And then there was a Fang M or Fang with that added Microsoft to it.
Yeah.
Because that wasn't good enough. I mean,
right.
we have all these, the BRICS.
Yeah.
Well, back when emerging markets, it was the BRICS. Everyone's talking about the BRICS.
Brazil, Russia, India, China.
Yeah. Now you talk,
Yeah.
I mean, it's talked about now, but more so on a currency or geopolitical standpoint, not from an investment standpoint. And then you had the pigs, and that was, what is it? Portugal, India, Germany, Spain. I think
that's right.
Greece.
Yeah. Greece.
Greece. Yeah.
Probably not Greece, but
no. Okay.
Probably maybe Germany. Who knows?
Kind of coincide with James' question too, and what Diana's asking about the bubble. Well, the bubble, it's a valuation. It's a valuation question, because you think, well, it's just getting overvalued, or just, well, the prices are high. Well, the Dow's 48,000. It can't just keep going up. And it's like, says who? When did it go down permanently? Well, it hasn't. Yes, we have temporary declines, and there's going to be all kinds of different factors and different things that are happening that cause those from year to year. But the biggest driver of stock prices is earnings. And we mentioned too, back in 96 to 2000, that big run up. Well, and earnings didn't keep up back then. So if you compare the biggest 7 stocks back in 2000, in the year 2000, they were tech companies back then too.
Mm-hmm.
Microsoft, Cisco, Intel, Oracle, IBM, Lucent, Nortel.
Okay.
Well, the 24-month forward P at the time was 52. So that's the valuation metric. You're
price
paying
to earnings ratio. Yes.
Yeah, you're paying 52 times in price for $1 of earnings. Well, for the Magnificent 7, the top 7 in the S&P 500 today, the 24-month forward PE is 23.
Okay. And that is based on estimates. Forward means there's analyst estimates, consensus.
Those are all estimates, and those will change based on actual results. And this is as of through the estimates from Q3 going forward.
Sure.
24 months. But their earnings power is they're earning so much more for $1, for what you're paying for the price of those stocks. Their valuation is not in bubble territory at all, especially compared to history.
Excellent.
All right. Well, that's probably a good place to wrap up here. And I think one of the keys today is getting back to something you said earlier, Bill, and that we always stress on these episodes is just the power of the plan. So we talked about risk. We talked about uncertainty. We talked about bubbles. We talked about the Mag 7. At the end of the day, we can model some of that. We can model the risk. We can prepare for the uncertainty. And the key piece of all of that is the financial plan.
That's right.
And so I think that's sort of the moral to the story here is we can never get away from the plan. And as long as we're planning, we're probably going to be in pretty good shape. We're going to be resilient. And we make adjustments along the way as well, of course, because of uncertainty. Things happen, and we'll make adjustments as need be. So guys, as always, appreciate it. And for each of you listening, please make sure that you tell all your friends and colleagues about the show here. We'd love to get more folks listening to it as well. We also have the YouTube channel. So these are actually being videoed, and we are posting those on YouTube. So make sure you check that out and subscribe to the YouTube channel as well. If you have any questions or comments about what we're doing here, please visit us at keenwealthadvisors.com, and we'll catch you on the next episode of Keen on Retirement.
Excellent. Thanks, Matt. Thanks, Steve.
The Steve Sandusky Advisor Network and Belay Advisor are not affiliated with Keen Wealth Advisors. Opinions expressed by Steve are his own and not necessarily the opinions of Keen Wealth Advisors. Keen Wealth Advisors is an SEC-registered investment advisor. Advisory services are only offered to clients or prospective clients where Keen Wealth Advisors and its representatives are properly licensed or exempt from licensure. The contents of this podcast are intended for the residents of the United States of America. No advice may be rendered by Keen Wealth Advisors unless a client service agreement is in place. This program is intended for informational purposes only and should not be construed as advice on or a recommendation of any particular investment, strategy, or as tax or legal advice for your specific situation. Keen Wealth Advisors is not a tax or legal advisor. To determine which investments may be appropriate for you, consult your licensed professional prior to investing. Information in this program was compiled from sources believed to be reliable. Due to the constant state of data changing, we do not guarantee the timeliness or the accuracy of the information provided. Our views or opinions at the time you are listening to the podcast may be different than they were when the podcast was recorded. Past performance is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any prices that are referenced or market forecasts are as of the date stated and are not necessarily our opinions moving forward. As always, please remember, investing involves risk and possible loss of principal capital. This podcast is not allowed to be copied, distributed, published, or reproduced without permission from Keen Wealth Advisors.